All right, welcome back, guys, to the Genesis Block podcast. Today we are performing a protocol analysis. So we have Siddharth and Yash here with us. Today, the protocol in question is Tokemak, and Siddharth is gonna, present to us his investment analysis, essentially of the protocol, and then Yash and I are gonna question, scrutinize, really stress test his thesis. So with that, Siddharth, over to you.
Perfect. Thanks, Ed. So before I dive into exactly what Tokemak is about, I think that the way that I'm gonna go about this is I try to structure the way my analysis essentially. The first thing that we go through is the overall trend of the DeFi space, which is where Tokemak sits within, and what the trends are, why it's important for a protocol like Tokemak to come about, and what exactly it does, and what the some statistics around it is, essentially aligning with the investment template that we discussed in the prior video, right? So let's dive in, right? So Tokemak is a DeFi protocol that can be described as a decentralized market maker at a very high level. It's aiming to create a liquidity infrastructure layer that's that can be utilized by DAOs, by new DeFi projects, market makers, exchanges, etc. So the way that I would describe it is that it's essentially a DeFi meta governance protocol that allows for liquidity to be apportioned to a variety of different exchanges by holders of the Toke or token. Before we go into exactly how Tokemak works, we'll just rattle off some of the important stuff around Tokemak. So firstly, it's built on Ethereum, but it's planning to be a multi-chain protocol, which is encouraging, because if you believe in a multi-chain future, a protocol or an application that's built across blockchains and provides liquidity across blockchains and exchanges and dexes across blockchains is a beneficial place to be in. Currently, they've raised around $4 million. With their investors, including the likes of Framework Ventures, Electric Capital, Coinbase Ventures, Delphi Ventures, Consensus, and North Island Ventures. So that's a pretty hefty stack of VC backing. $4 million is a small amount of seed funding raised, but as we'll go through later, the team have managed to do quite a lot with that 4 million already as well. So let's just speak at a very high level about some of the trends that we need to understand in order to contextualize Tokemak and the place that it will occupy in the wider DeFi and Web3 ecosystem, right? So firstly, let's talk about DeFi 1.0, the way and DeFi summer and all the things that it brought out. Right. So the way DeFi 1.0 worked was through liquidity mining, which was providing incentives through the means of extremely high APRs and APYs to liquidity providers, and distributing a ton of the native token to liquidity providers, right? But as we've realized over the last year or so, DeFi 1.0 and liquidity mining came at a really high cost for protocols. So firstly, liquidity is mercenary. Capital is always in search for the highest yield. So when the incentives provided by protocols to liquidity providers dry up, then the liquidity providers just ditch that protocol, and move to another one which is offering higher APRs. So what that means is that the liquidity that a protocol has is rented for a short amount of time at extremely high costs, which doesn't allow it to be sustainable in the longer term. And so as an example, Compound has distributed more than $271 million of comp tokens in order to attract liquidity, right? But it's earned $29.1 million in protocol revenue over this entire period. And all of it is currently allocated reserves. So that means that you can argue that Compound's been operating at a loss over this period, right? So, and because you're increasing supply so much, you can also say that this liquidity mining has caused a lot of downward pressure to be put in the comp price, because the rewards that come into the market are sold by yield farmers. So liquidity mining, while it was a very headline grabbing way of attracting liquidity, it's not very sustainable in the long term. Another one is that as rewards dry up, right? The high cost, high risk model of liquidity mining, it doesn't allow the digital asset ecosystem to scale effectively. So Tokemak operates in a very important space within this trend, right? Another couple of trends to keep in mind are meta governance. So what is meta governance? Well, meta governance can be defined as holding one protocol's tokens or another protocol's tokens in order to essentially influence its direction, right? And meta governance can be seen most effectively in the curve wars. So not going to go too deeply into what the curve wars are about. If you want to have an understanding of that, read up the two articles published by the Noah Substack. They're very good in explaining what that is. But essentially, Tokemak can potentially play a very important part in meta governance, and we'll go through why in a little bit after we explain exactly how Tokemak works. It should become pretty apparent, right? And another one is obviously the growth of DAOs over the last few months, and that have come back roaring into prominence after a few years of lying in stagnation. So the growth of DAOs is very important, and as Tokemak, one of its primary use cases is for DAOs. The growth of the DAO ecosystem and the explosion of the number of DAOs globally, it's an important factor for Tokemak's success going forward, right? And another one and another trend that you can kind of subscribe to is kind of aggregation theory, which is network effects, right? So and I think we can go into this later on as well, but as the use of Tokemak increases, its power increases. So and this is similar to what the Web 2.0 giants, the tech giants have done over the last decade and a half, including Facebook, Amazon, etc., etc. Network effects, economies of scale, all those kinds of things have propelled them to the highest of highs. And Tokemak will also play an important role. Aggregation theory plays an important role in the future of Tokemak. But so just important to keep those trends in mind when assessing Tokemak, right? But now let's dive down into how Tokemak actually works. So the traditional way of providing liquidity is by adding liquidity to a pool in a and that pool consists of two assets, each of which are equally balanced, right? But as we've discussed, liquidity mining has quite a lot of problems. So what Tokemak does is that it has it has token reactors for each of the assets that it supports. So, for example, you deposit a token into a token reactor, right? And there are liquidity. So liquidity providers deposit the tokens into token reactors, and they stake and essentially they stake it there, right? And reactors are so the liquidity providers deposit it to the token reactor. And then there are a second form of actors in this ecosystem, which are called liquidity directors. What liquidity directors do is that they decide where those assets are deployed, and they also stake Toke to a reactor. So here, what you can see is that in a token reactor, you have a native asset, let's say ETH, and then you have Tokemak, you have Toke. So the ETH is deposited by liquidity providers. The Toke is staked by liquidity directors. Now, reactors are intended to be balanced. So you want to have a 1-to-1 ratio between the value of liquidity provider deposits and the Toke staked by liquidity directors, right? So liquidity directors then determine where liquidity is allocated. So they can choose to allocate their Toke to one. So they, if they've stake Toke, they can stake it to one reactor, two reactor, three reactors, however many. So then what that stake Toke allows them to do is vote on which exchange they would like to see the liquidity allocated for. So let's say they want, ETH, the liquidity for ETH to be allocated to Uniswap. So they say, okay, I've got Toke staked in this reactor, in the ETH reactor. I want to vote on the ETH being allocated to Uniswap and provide liquidity to the Uniswap DEX for ETH, right? So the voting power, obviously, as you might have imagined, it's proportional to their share of the total Toke staked to a given reactor. So let's say there's like 100 Toke staked and one liquidity reactor has 1 Toke, they will have 1% of voting power, right? So liquidity then is directed to an exchange for 1 week intervals known as cycles. So liquidity. So what happens is that for liquidity providers, it's actually pretty simple. The concept is similar to providing liquidity to a DEX, but you don't have to go through any front-end interface that interfaces with the DEX itself. Users just deposit directly into Tokemak, and the Tokemak then just routes that liquidity for them. So it abstracts away a lot of the complexities of being an LP. So liquidity providers earn their yield in the form of Toke rewards, and they receive a T asset. So it's like a representative form of the asset that they've staked. So it's a 1-to-1 tokenized claim on their underlying deposits, right? So similar to what Compound, Aave, or Yearn do. So liquidity. So what's very interesting about Tokemak is that for liquidity providers, these deposits are single-sided. So because of that, they are shielded from impermanent loss because they only deposit one side of they only deposit one asset, right? Because usually, let's say that they wanted to in DeFi 1.0, they wanted to deposit ETH, they would have to pair it up with another asset and then be exposed to impermanent loss. But now, because they only deposit one asset, they are not exposed to impermanent loss. Instead, the risk of impermanent loss is shifted rather than eliminated. It's shifted to liquidity directors, right? So liquidity directors are also compensated in the form of Toke rewards, but because they have staked Toke against that specific asset, they are exposed to impermanent loss. But at least for liquidity providers, this is a better system, right? What liquidity directors also do is that they maintain equilibrium across all reactors. So because balanced reactors produce the most amount of emissions for liquidity directors and liquidity providers. And if you have unbalanced reactors, so if you don't have 50% Toke, 50% ETH, or 50% any other asset, you can be exposed to impermanent loss, the reactor can fail, etc., etc. So these are the two main components of the Tokemak ecosystem. The third one is prices. So for any protocol that doesn't utilize, or for any DEX that doesn't utilize an automated market maker, like 0x, for example, Tokemak has prices. So prices are essentially like the market makers that exist in the real world, right? So they allow for real-time pricing information for any protocol that doesn't utilize an AMM. So pricers will set buy and sell order prices. They use a separate pool of Tokemak assets to maintain the assets market, right? So that's a separate component, but that kind of shows you how Tokemak is essentially working alongside, dexes that have AMMs, dexes that don't have AMM, etc. So just to illustrate very quickly how this works in practice. So if you want to provide $20 million worth of liquidity in, let's say, the ETH Aave pool on Uniswap, the Tokemak protocol, it would take $10 million worth of Aave tokens from the Aave reactor and match it with $10 million worth of ETH from the ETH reactor, and then just deposit the liquidity on Uniswap. So that's how it actually routes liquidity, right? And that allows holders to essentially decide which tokens on which exchanges have a lot of liquidity, right? And that's where the meta governance angle comes in, and we'll expand upon that. In a second as well. So how did Tokemak actually come about, right? So its first event was cycle 0, so it was called Genesis. So it lasted 1 week. Participants were able to commit ETH or USDC in exchange for Toke. It allowed them to build out their protocol controlled assets. So like, how Olympus now introduced the idea of protocol controlled assets or liquidity. Toke also wants to, in its long-term roadmap, use this entire mechanism to completely build out its protocol controlled assets by a certain amount, by a certain point in time, and which I think is around 2 years down the line, based on their token distribution scheme, and essentially use the protocol controlled assets that they have in their treasury to unilaterally allow Toke holders to direct liquidity from protocol controlled assets into different exchanges. So that's the end game, right? But currently, obviously, they're still bootstrapping. They're still getting assets into their treasury, which is why they're giving out all of these emissions, rewards, etc., etc. What Tokemak is doing is that reactors. So there was voting that concluded in November. So reactors was secured in November by a crypto trading and management platform called Shapeshift. There was a market making protocol on Uniswap called Visor. Synthetics, which is a synthetic asset issuance platform. Illuvium, which is a play to earn game, and yield tokenization protocol called APWine. So all of these guys secured reactors for their tokens. Essentially, in the future, according to the founder, Carson Cook, in the future, Tokemak's DAO could vote to pay out the yield generated from the protocol controlled assets treasury pool to Toke holders, or use the yield to burn and redeem Toke to put deflationary pressure on the token. So that's how the deflationary aspect comes across the value accrual of the token, right? In either outcome, as you might have surmised, Toke holders would have a pro rata claim on the treasury, so they would actually control the protocol owned assets, right? So this gives them access to a pool of revenue generating assets. So what Tokemak essentially sees itself as is the decentralized liquidity provider across DeFi. So it sees liquidity as bandwidth. So and this is what it said a lot in its documents. But what this means is that liquidity is it sees liquidity as the most critical infrastructure of the token ecosystem, which I can agree with, because without deep liquidity, no token is going to succeed, right? And if you can, and a lot of DeFi projects that we've seen are variations on ways of trying to bootstrap enough liquidity to their own ecosystems. If you want to talk about the use cases and benefits that Tokemak brings about, so firstly, for DAOs. DAOs can use Tokemak to provide single-sided liquidity for tokens that are locked in vesting. So it can provide assets in its treasury as an LP into Tokemak. So it can hold the key assets in its treasury and essentially gain rewards in Toke, which can allow it to also then direct the flow of its own liquidity to other exchanges, which makes its own asset have deep liquidity across a wide range of venues, right? Um, so a lot of so this allows them to bootstrap a lot of liquidity for their ecosystem. For stablecoin issuers of stable token issuers, especially algorithmic stablecoins, they could use Tokemak as a distribution pairing mechanism with their tokens. So you could have robust liquidity pairings with their tokens, right? So if you essentially use Tokemak to direct liquidity through with a bunch of different assets. So let's say there's an algorithmic stablecoin provider, and they can essentially create pairings between their asset and a number of other assets, which makes their asset more usable across DeFi, etc. So Tokemak can also be used by DEXs to direct a lot of liquidity to their platforms, which makes their platforms a lot more attractive for users to use. So instead of massive, huge DEX spreads, or the broken model of liquidity mining, the Tokemak token can be used to direct liquidity for a protocol. So you reduce spreads, you reduce the cost of liquidity. That has material benefits on the bottom line for any protocol, right? Just to bring that out again a little bit, today DeFi project founders apparently spend anywhere between 25 to 75% of their time on issues concerning liquidity, sourcing, management, market making. And on top of that, projects pay an average of around $1.25 in their native token for every $1 of liquidity secured, which is obviously a very inefficient inefficient system that's not really going to last. So what Tokemak estimates that it can do, it says that with its liquidity as a service protocol, essentially, its founder Carson Cook says that the figure could be reduced by 3 to 4 times, which is huge. And obviously, it's to be seen whether this is actually viable. But the mechanics of the protocol seem robust enough to be able to allow that. So just to talk a little bit about the Tokemak team now. So the founder is Carson Cook. So he is so I listened to a podcast by him on podcast interview with him on the FinTech Blueprint. You guys should go out and listen to that one as well. So he has a PhD in physics and a master's in electrical engineering, ex-McKinsey, founder of Fractal, which was a cryptocurrency trading and technology firm. They use algorithmic strategies to provide liquidity. So, he has prior experience in this liquidity provisioning sector. And so he began operating as a market maker on centralized exchanges in 2018 before shifting to DEXs and decentralized trading platforms towards the end of the year. And then obviously started thinking about, how he and his team could decentralize their market making operations using DEXs in around like 2019. So one thing to note is that he's not anonymous or pseudonymous or anything like that. They're docs, so they have social clout to lose. This project seems like a very interesting one for someone who's so deeply involved in numbers and essentially understanding the structure of an ecosystem, like he does, I guess, having been involved in the market making space for a while. It's interesting to see the way in which he and his team are trying to disrupt the market making ecosystem. And another thing to note about the team is that the SushiSwap co-founder, OX Maki, he's joined Tokemak as his new chief strategy advisor. So that's also a pretty interesting development for the team, because it seems as if they're getting experienced hands on board who can actually contribute significantly to the growth of the protocol. So that's one thing, right? I will, I can actually stop you if you guys have got any questions around, how the protocol works, anything like that, before continuing on. Give myself a break as well.
Yeah. So, basically, the way I see it is that, Tokemak is going to
have like Curve was 2.0 essentially, the way it's going, because Curve, you require Curve tokens to direct emissions, which created Convex to hold Curve
Exactly.
tokens and govern the protocol and direct emissions. So now in this case, it'll be, I'm assuming, pretty much the same thing in the near future, where protocols will try to hold Toke to direct protocol control liquidity of Toke to whichever protocol they want to, right? So,
Yeah.
I mean, we could really see that brewing in DeFi 2.0, which would be very interesting to see. And
Exactly.
yeah. So the question I had is, how is Toke different from Olympus DAO and even Tribe DAO by extension? How does it operate differently? And since they're all competitors, what will guarantee one of the protocols to win? These DeFi 2.0 wars, I guess, in the future.
So I think that more than being competitors, I think they might be a little more complementary actually. Olympus DAO is a different case because essentially, if you break down what Olympus DAO did, it was essentially a hedge fund, right? Like what it was a decentralized hedge fund that saw insane increases in its valuation compared to the actual assets that it's held in its treasury. And once people realized that the assets that it held for a longer term couldn't get as much yield as the valuation promised, the valuation came crashing down. But Olympus doesn't provide liquidity to any other protocols, right? It's not essentially like a fount of liquidity. It's just in my mind, it was like a decentralized hedge fund, and I don't really know why they went with all that reserve currency business. It didn't really make too much sense to me. I think Tribe DAO is an interesting one because they've got their fuse pools, their isolated lending pools that are that are slightly different to what Tokemak is doing, and also obviously the merger with Fei protocol means that they have their own stablecoin as well that they can use to bootstrap all of these different lending pools, right? The thing is that it's a slightly different model as well because you're essentially creating a lending market on using the rarity pools on Tribe DAO, while Tokemak, in my opinion, what it does is that it's just a director of liquidity, right? It's a meta governance protocol that allows different DAOs and different protocols to actually source liquidity for their tokens, have their tokens be liquid as well through the T assets, and also essentially allow for deeper liquidity to be attained for their tokens, and that's basically it, right? And the other two protocols that you mentioned, they're not really market makers. I think Tokemak seems like a market maker. It seems like what a definition of a decentralized market maker would be to me. So I think that those three are kind of different. I think Olympus, actually, it's worth keeping an eye on what they do, because even after all of the price rout, they've still continued pushing updates and releasing new stuff. So it'll be interesting to see what they do. But I think it's a different ballgame to what Tokemak is doing.
I mean, the way I see it, it's on a spectrum, right? There's like Tribe DAO on one side, where you can create individual lending pools, and then there's Olympus DAO, where they literally own all of the assets, and you have a baseline price for all these assets, and it can go higher than that, but anything lower than that, and you can do arbitrage and get the price back up. And then Tokemak is like in the middle of these two, where you're not exactly owning the liquidity yet completely because they're still trying to bootstrap it, but they're not just a lending pool either, right? So it's bang in the middle of these two in a way.
Exactly. And I think like one of the good things about Tokemak is that, there are so many tokens that DAOs just have in their treasuries, their native tokens. Like, for example, if you look at Uniswap, right? Uniswap has got a ton of Uni tokens in its treasury. And if any of that came flooding onto the market, it would completely disrupt Uni's liquidity. But what it can do through Tokemak is that if it takes those tokens from its treasuries, gets the assets, and then starts to like slowly route those route its liquidity to different exchanges if it needs to. It's an interesting proposition because you can actually be more capital efficient by using what's just left static in your treasury of your own tokens.
Right.
I have a not a question, but I want to summarize what they do, just because I am not too clear on if my understanding is correct or not. And I want to, like, not use the jargon. Like, I want to explain using words that are already commonly used in
Okay.
in crypto, as opposed to Tokemak specifically or DeFi too, right? So let me do that, and then stop me, or if I'm going wrong somewhere, or any point you think is important. So you have the reactors, which you mentioned, which are essentially pools of liquidity, right? Now this reactor or this liquidity pool, the first, and right now I'm just talking about AMMs. I'm not talking about the prices and their function. So the liquidity pool gets 1/2 of its liquidity from assets that are not Toke. And these liquidity providers, they of course have the benefit of providing liquidity without impermanent loss, but also they are incentivized by the Toke emission, as well as the eventual incentives that they would get by providing liquidity in any decentralized exchange. So it's two incentives: one, Toke emission, plus the fees that would be eventually generated on the DEX the liquidity it lands upon. Is that correct up to now?
Yeah.
Okay. And now the second side of the DEX, the liquidity pool in this is coming from Toke stakers. Right? And Toke stakers as well are, of course, incentivized to do so, because one, they own the right to direct liquidity to whichever DEX or wherever they want to, essentially, but also they're incentivized by further Toke emissions.
Exactly. Yeah. So they're incentivized by Toke emissions. Yeah.
Okay.
And
Okay. And there is only one type of reactor. Like, there's only one liquidity pool type, in the sense, this concept of liquidity pool, or this concept of reactor in this case, there are multiple types of them. There's just one standard liquidity pool, which we call reactors. And in this and each protocol will have its own reactor. Or I should say,
each asset would have its
asset would have its own reactor. And then in this system that's been developed, where both these players essentially provide liquidity to earn Toke emissions, as well as for the non-Toke stakers, the fees that will eventually be generated, they'll earn that as well. And then the liquidity and the Toke stakers then essentially direct this liquidity to whichever protocol the consensus is. Is that essentially, did I get that right?
That's the way it works. Exactly right. And that's exactly how it works. I think you've got it correctly. And another thing that, like, it's interesting point out is what Yash brought up, in his question, and like just about the curve walls, right? And you mentioned convex. Now, what have we not seen yet? Is the creation of something like convex for Tokemak. So that incentivizes. So essentially, if you own convex, you own a lot of curve. If you own X, you might own a lot of Toke, right? So there's still a gap, I think, for something like that to come out in the meta governance aspect. And it'll be interesting to see what happens in the Toke wars and that. But to that, there's been a bit of there's been a website that's been created by Tokemak, or I think there's a website, sister website called it's the Toke Wars dashboard. So if you want to go on slide 4 of this presentation, there's a dashboard that kind of shows you, who the Toke holders are. So, I think this was a few days ago, I think, that I got the screenshot. But, so DAOs own $17.5 million worth of Toke. This is a circulating supply. There's 11 DAOs that are accumulating right now. Considering we're like literally in the first innings of Toke, it's pretty impressive, seeing how the amount of Toke held by DAOs has increased. Obviously, you can see here some of the DAOs are, the ones that obtain the reactors, like Synthetics and AP Wine and Shapeshift. But you can also see how the curve wars are playing into this redacted cartel. It holds quite a lot of Toke. And another one that's very interesting, and the newest and most brash, I guess, entrant into the curve was, which is Terra. Terra saying that it's going to be using the hidden hand market, which is like a bribe market, right? To secure its own reactor within Tokemak. So this tells you how even the largest L1s are essentially looking at Tokemak as a way of bootstrapping and maintaining stable liquidity. So that's a pretty interesting development in my eyes. Cool. So I think, yeah, I'll just continue on. If you actually go to the first slide of this of the PowerPoint, yeah, sorry, the next one. Yeah, so I think like what we can talk about are some of the key statistics around Tokemak. Active developers, very difficult to get a hold of that. But there's a lot of information available about quite a few of the other statistics. So actually, the important one would be the third row, which is revenue earned. Now, for the last 30 days, Tokemak is actually 11th in crypto protocol revenues for the last 30 days, which is a pretty great performance in my eyes, right? And we can see this as well. Like if you go on to, sorry to keep on moving, but if you go on to slide 8, you can actually see that figure. Right, so you can see like obviously Ethereum and Ethereum is the highest, Luxrare, OpenSea, etc. But Tokemak, having been seeded for $4 million, is already earning $4.4 million worth of protocol revenue in a month, which is a very impressive figure in my eyes. And obviously it's in the early part of his journey, so this could very well increase significantly. If you go back onto the statistics one again, sorry. There's some others that we can talk about. There's the amount staked. So yeah, so like the amount staked has been, it was $437 million staked at peak on Jan 15th. There's a big decrease right now. But I think it might be because of the crypto the market downturn, but not exactly sure what's caused that. So that's one to keep an eye on, and a possible risk vector. Twitter followers, again, like this is pretty stable. I guess an increase of 10% over the last 90 days, nothing, huge compared to crypto protocols, etc. It's if you compare its sharp volatility, sharp ratio, it's comparing its performance to a risk-free asset. So it's a crypto protocol. Early days might not be as useful a metric to use, but compared to other DeFi assets as well, it's not done very well. It's got a sharp ratio of minus 1.99 over the last 90 days. It's also been less volatile than other DeFi assets over the last 90 days, which is also an interesting fact. Although you don't need to. I don't think this is one to keep a huge amount of stock in it at this early stage. The total supply is going to be 100 million. So it's the current supply is around 7.4 million. Fully diluted value, I think we spoke in the last video around the drawbacks of using this metric, but it's $1.8 billion. But that's, again, you can't assume that all tokens will be valued the same way when they're all released onto the market. And the liquidity is medium. It's listed on Uniswap, V2, Gate.io, etc., but not on any of the biggest exchanges. So there is some liquidity, but there's not a huge amount. And I guess this is I guess a good sign as the protocol increases in in prominence. It'll get more liquidity on the larger exchanges. 3 contract audits, which is not bad actually. The latest was in February 2022. And this is an important part to consider because smart contract audits are very important, especially when there's so much money locked up in these smart contracts. And yeah, so I think that's kind of what I wanted to go over around the, just some key statistics to keep in mind, right? Now, what I want to talk about is the tokenomics. And that's, I think a lot of it is what we're interested in, right? So the token essentially, it plays a lot of roles within the Tokemak protocol. So you get governance over the Tokemak DAO, which when it forms, and we'll talk about governance a bit later, although there's not much to touch upon there currently. It provides incentives for liquidity providers and liquidity directors. It's the protocol backstop in the event of extreme impermanent loss and like the worst market conditions. And obviously tokenized liquidity or liquidity direction. So that's an important one. So because it can be, because it allows you to direct liquidity, it's a bit more of a commodity, right? So it's not just a governance token, but it allows you to do more with that because it allows you to actually direct liquidity. So it's one of those DeFi tokens that you're just like, oh, okay, what kind of bucket is this in? I'm not really sure. Gonna have to analyze this a little more carefully, right? So because you own Toke, a holder or entity, they can plug into the liquidity within the system. And therefore the token itself is a highly valuable resource for many entities, and it turns liquidity into infrastructure. So while the liquidity generated for protocols, it doesn't grow protocol owned values like Olympus. It's a longer term model. It can offer slightly different incentives to Tokemak. So Tokemak actually it retains all the trading fees in return for bearing the risk of impermanent loss, right? So when we discussed it earlier, I actually said what I'd like to amend is that liquidity providers get Toke emissions, but the Toke token itself accrues the fees generated from trading on dexes. And that's obviously, that's kind of for liquidity providers, it's kind of a hedge. So you're like, oh, do I want to bear the loss of impermanent loss, or do I want to get all the trading fees? Now Tokemak is saying I will bear the risk of impermanent loss, but I will keep the trading fees. So these are the trade-offs, right? And essentially these trading fees are retained in the Tokemak treasury as protocol controlled value. So over time, this is linked to the what I said earlier around Tokemak aiming to accumulate enough trading fees in order to direct liquidity independently without the need for LPs, right? So this is the end game. This is what the goal is at the end. So it wants to be self-sufficient. And Toke itself has DAO governance rights, and it will provide a pro rata claim on protocol control value. So that's an important aspect as well, right? So it's not just a bunch of empty air that the Tokemak token has. What Tokemak rewards will also be used to incentivize the assets that are deposited into Tokemak. And so dynamic rewards, so you change the amount of rewards per reactor, so it incentivizes the reactors of the pools to be balanced in each reactor, right? So overall, if you kind of count down the ways in which Tokemak generates overall revenue and the way that the token itself accrues value, it's through trading P&L, so AMM style fees, liquidity rewards, idle yield. So you can, if you've got idle assets, you can just deposit them to a compound Aave, one of those protocols, to earn yield rewards. And Toke liquidity mining rewards, right? So this is the way that the Tokemak token itself accrues value. Now, what we want to talk a little bit about the token release and the token distribution and vesting schedule, right? So Sid, if you actually go on to slide 10, we can first kind of try and benchmark what the optimal token distribution might be. So there was a really good article by Cooper Turley and Lawrence Stefanian for what the optimal token distribution might be. So we can, again, I think we spoke about this in the investment template video and podcast, and we'll link it in this one as well. But essentially, the suggested token distribution is 17.5% each to the team and investors, 50% to the treasury, 5% to the as an airdrop, and 10% as ecosystem incentives. Now, obviously, every project cannot abide strictly by this, and I think I can try and explain a little bit around how Tokemak is going to be doing its token distribution and why it's done so. So if you go on to the next slide, we can kind of look at how Tokemak has done it. So 30% of Tokemaks will be reward emissions. And 5% is the degenesis event and the first distribution of Toke. So you can say 35% is ecosystem incentives, right? And this is important for Toke because it's using actually those ecosystem incentives to build up its treasury rather than just allocating Toke to its treasury. So it's kind of a similar way in which, you say 50% treasury, but actually you're using your incentives to build up your treasury. So that's a good thing in my opinion. So because it says that the reward emissions will go on for about a couple of years, I think. It's until which point Tokemak will expect to have enough protocol controlled assets to provide liquidity without depending on LPs. So, because this is a deviation for the above distribution, but it seems apt for Tokemak, given its longer term model, encouraging that the distribution for investors is in line with the above model. So it's actually, 17% to 17.5%. It's the same thing. It's actually a little better, which is very encouraging. The amount held in the treasury is only like 9%. But which is much lower than the 50%. But this is caveated by the fact that the reserve or treasury will build up over time. And this can be viewed in conjunction with the reward emissions, since these are aimed to be staked in the reactors. The distribution is for the team is higher than the suggested distribution, but 14% is reserved for the core team. So this is in line with the suggested distribution. The definition of contributors is not clear, which is another point to keep in mind. So who are contributors, right? Like how do you decide that? What is the governance to decide that? So that's kind of another thing to keep in mind in terms of risk. Like how do you decide that, right? So it seems like there may be more Toke reserved for the team than is necessary. So this, ideally you might want to allocate a little bit more of that towards the treasury, or building up the treasury over the longer term. Something like maybe what Terra's done, but this is a point of debate. It's how much is good enough for the team and to incentivize contributors, etc. to especially a protocol like this one, which will require tending over the longer term. As the treasury grows, the community will have a claim on the treasury assets, so this will ensure a higher level of decentralization. So there's no public sale of the tokens, which is better. So that's actually a pretty good thing. So another thing to note is, when you see the 12-month cliff and 12-month linear vest for all of these tokens, what this can indicate is that supply will start unlocking from August 2022, because August 21 was when the protocol released. So this could place downward pressure on the price and add sell pressure, since investors, contributors, the team, they've got tokens at lower prices. They might want to lock in their profits, right? So as prices dip, but retail buyers may also want to sell and cut their price losses. So this could create more selling pressure. So if you see a downward pressure on the sale price as of August this year, that might be the reason because tokens are vesting, not because Tokemak is doing terribly as a protocol. It's just the dynamics of how the token distribution occurs, right? So yeah, that's how the Tokemak distribution occurs. So as I said, the emission schedule for the protocol participants is currently designed to be emitted over 24 months. So 104 weekly cycles. So these emissions, but however, these emissions could extend past this length of time. So as of now, I think that they think by next August 2023, actually, they should have enough assets in their treasury to independently direct liquidity and become self-sufficient. And I think the last thing that I want to talk about is the governance model, and then I'll stop for you guys to ask any questions. So Toke holders today maintain certain governance rights, but not too much. Once the singularity is occurred and the Tokemak DAO is formed, so once essentially they have enough assets in their treasury, the control of the protocol will be transferred entirely to the DAO with the and liquidity directors will be compensated. So that's an interesting development to watch out for. But that kind of also indicates that it's not a DAO right now. It's not very decentralized. But again, as we know, decentralization is not a silver bullet. It doesn't also happen instantaneously. It takes time, and I think these guys start trying to progressively decentralize is a good thing. So the singularity doesn't require third-party assets to balance the reactor. So liquidity directors will maintain two-sided control of the liquidity through their reactor and exchange-level voting power. So liquidity directors will be empowered when the Tokemak DAO is formed. And right now, however, there's no governance channel in the Discord. They want to build out a governance structure, so they want to dialogue with the community, forums, Discord, etc. And the goal is for the governance to be able to vote on things like standing up new reactors, new venues for directing liquidity, or new L2 or cross-chain implementation. But right now, that's not there. I think since we're still in the early stages, that can be forgiven a little bit. But if this, if they don't focus on governance towards the back end of this year, then we might start to get a little bit antsy and go like, why is this, acting in a more centralized manner? Why is there no governance for this? Why are there no good governance practices? And good governance is at the bedrock of a good protocol. So if this isn't created well, and if it's not designed well, then it won't do well. But the jury's still out in that, and I would give them the benefit of the doubt. So yeah, that's essentially my analysis on Tokemak. And I think that if we want, we can actually go over some of the some of the other graphs for like 2 seconds just to see some of the growth. So if you go on slides 5 to 7, Sid, you can kind of see, the Toke holders over time. So from August, obviously when it's launched till now, there's been a good increase, but it's not, anything crazy. If you go on the next one, the assets staked reduced significantly, as you can see, as I mentioned earlier on, in about March. And it's slightly growing up again. Not exactly sure why the T assets, staked via LPs have reduced so much, but that's a pretty big risk factor in my eyes to keep an eye on. And the next one is just the protocol controlled assets, right? So now the protocol controlled assets that it actually owns is a bunch of different ones. Again, this is, I think, decreased in lockstep as well a little bit with, the price of Ohm and the price of crypto assets in general decreasing a ton since the highs in Jan and November and stuff. But you can see it holds a diversity of assets in its treasury. But yeah, that's about it.
Right. I just have one question really, and of course this is more understanding the protocol, because to ask and question regarding the long-term sustainability and whatnot, at least for me right now, it will be a bit premature. So in terms of just understanding the protocol, right, I had a question regarding how new reactors are decided, right?
Yeah.
Is it just general voting based on how much Toke is staked, or how does that process work?
Yeah, so it's voting. So essentially, there was voting that occurred in, in November. There were 2 rounds of voting, as I understand it. So whoever you stake Toke to a certain reactor, and essentially vote for which reactor to secure. So like Toke holders essentially voted for Shapeshift, Visor, Synthetics, Illuvium, and AP Wine to secure their reactors in the first round of voting. So I think they're going about it in a systematic manner. But yeah, it's essentially through voting and through stake Toke, etc., etc.
Got it.
Cool. Anything else?
No, I think this is pretty complete as an analysis. Couldn't really do any more than this, I think.
Cool.
Yeah.
I think, just to sign off then, I think, in my eyes, I think Tokemak is a very, very interesting protocol. Definitely worth keeping an eye on. Again, this is not financial advice or anything like that. Not assess anything about the price, anything like that. It's just find it very interesting to analyze these types of protocols and understand what role they play in the Web3 ecosystem. And I think Toke is because it's a bit of an infrastructure play within DeFi, and an interesting way in which liquidity is directed, an interesting play on DeFi 1.0, DeFi 2.0, all of those trends coming together. I think that it's definitely one to keep an eye on. I think that it's going to do very well. I actually have a lot of conviction in the founding team, after especially having listened to Carson on the FinTech Blueprint. And just given his background and given the way the protocol is being built up, I think that this is one that I I think that this is one that I would, believe in for the longer term. And just as full disclosure, I do own some Toke. It's not an insane amount of Toke, but obviously, after doing this analysis, I obviously wanted to get some because I believe in its role within the DeFi ecosystem going forwards. But yeah, that's
one more question from my side. Can you just quickly go over the difference between the protocol controlled asset, which is on this slide, versus the T assets? So
yes.
so from what I
Okay.
understand, at least, T assets is the representation of your stake, but I'm not too clear how what the difference is between that and the protocol
So
asset.
this is the assets in Tokemak's treasury, which they've got through trading fees from dexes and
Okay.
a bunch of other ways. But like the T assets are the ones that have been staked or like that have been provided as liquidity to Tokemak. Those are two separate things, right? So there's these assets are controlled by Tokemak, while the other assets are controlled by the liquidity providers and liquidity is directed for them, right? So there's a bit of a difference between those.
So liquidity providers stake their assets,
They deposit their assets.
they
They deposit their assets.
their assets, they get the T assets, then the T assets are effectively used to generate what will then become the protocol controlled assets.
The T assets aren't used. So like, for example, if you deposit an asset into a reactor, and then Toke holders say, okay, let's say that you've got ETH, right? So you deposit ETH into a reactor, and then the Tokemak holders essentially say, okay, this ETH is going to be paired up with let's say synthetics, right? And you create a synthetics ETH pair and deposit it on Uniswap. Now, every time someone exchanges synthetics and ETH, you get trading fees from Uniswap that go into this treasury. The T assets are a liquid representation of the ETH that are given to liquidity providers in order to be able to do different things with them, right? It's the same reason why Lido gives you staked ETH that you can borrow against or something. It's the same kind of concept.
So then, I mean, just having said that, the huge drop off in T assets, while the gravity of the drop is very significant, and I don't think, I mean, of course, the general decline from before the huge drop can be attributed to the macro environment. I think this final capitulation is something that I mean, at least I would need more comfort on before
definitely
investing in this protocol. And then secondly, in terms of the protocol assets, right? I'm assuming this is total protocol assets, not assets that are generated in a period of time, right? So then, why would there be a drop off? So is this drop off essentially?
It's the price, right? I think. Yeah, it's the value.
Okay. Then this
for example, if you see Ohm, if you see Ohm, right? Ohm, they held quite a lot of Ohm earlier on. I think that's the blue one. I think that might be the blue one, right? And now they hardly have any Ohm because the price of Ohm dropped by like 95%. So obviously the value of Ohm that they hold will decrease. I completely agree with you though. Like I don't know exactly why there was such a big drop in stake T assets, but maybe there's a benign explanation, maybe there's not. But it's definitely one to consider as a risk factor and figure out why that happened.
Cool. Yeah, I think I'm pretty satisfied with my understanding as of today, at least.
Cool. Awesome. That's exactly what we're trying to do here. So yeah.
Great, guys. So with that, let's wrap it up. We're gonna, for all the viewers, we're gonna, when we upload this video in the show notes, we're gonna upload some supplementary material just to provide, a more in-depth view analysis on this. So which will hopefully help you also further, give clarity to your understanding. Should you choose, you want that. And then, we'll be back soon for another protocol analysis or some sort of, another video, which hopefully will give value and provide more insights in this entire Web3 crypto ecosystem we're trying to, we as well, including you, are trying to really understand.
Perfect. Thanks.
Yeah.
Thanks, guys. Cheers.
Great. All right. See you guys.
Cheers, guys.
Yeah. Cheers.